Hi everybody, Downing here. In this video I want to go a little bit beyond the basics of how traditional IRAs work. An IRA, by definition, is an individual retirement account, with the emphasis on individual. There's no joint titling allowed. One IRA means one owner. In order to contribute to an IRA, you must have earned income. That is, income from compensation, defined as wages, salaries, tips, alimony, and separate maintenance payments. These are all earned income. Income from capital gains, dividends, and interest is not considered earned income by the IRS, although it certainly is by you and me. They classify it as investment income. Your contribution limits are $5,500 per year. If you're over 50, an additional $1,000 catch-up contribution is allowed to make the total $6,500. But you can't contribute at all past age 70 and a half, even if you're still working. The big deal about IRAs is that you may be able to deduct the money off your federal taxes as you make the contributions. Say you're in a 25% tax bracket and you make a $4,000 contribution. You've saved yourself $1,000 in federal taxes. Another way to look at it is that $4,000 contribution only costs you $3,000. So that's a really good deal. But now, who can deduct the contributions? Well, they are fully deductible if you were not an active participant in an employer plan. Active participation means that something, even the first buck, went into your account during the tax year. Even if the employer made no contributions, but there were forfeitures allocated to your account, you had active participation, so be careful. You may also be able to do a spousal IRA. In this case, only one spouse works, but the working spouse can contribute to both IRAs. What if you are covered under an employer's plan? In that case, you've got an income phase-out regarding IRA deductibility. If you're married filing jointly, the phase-out range is from $98,000 to $118,000 AGI. This means that you have full deductibility below $98,000 and none above $118,000. In the middle, there's a phase-out. The phase-out range for single and head of household is $61,000 to $71,000 adjusted gross. And for married filing separately, it begins at 0 and goes up to the first $10,000. So very, very limited deductibility there. However, every taxpayer can do a non-deductible IRA. In this case, you've got to keep meticulous records because the withdrawals are going to be part return of contributions, not taxed, and part earnings, fully taxed. Now, how can you invest your money? In financial assets. That means bank accounts, stocks, bonds, mutual funds, ETFs, REITs, unit investment trusts, and so on. Life insurance, works of art, collectibles, precious metals, these things are usually prohibited with the exception of some U.S. gold coins. There is such a thing called a self-directed IRA, which can hold some of these assets, but it's beyond where we're going in this video today. The account owner cannot use margin to purchase securities, and most brokerage firms will not allow options trading either. So please don't confuse the rules between prohibited investments and prohibited transactions. A prohibited transaction is speaking about self-dealing rules. Again, kind of complex for today, but the bottom line is you cannot personally sell an asset into your IRA, nor can you buy it out. Now, what's taxation like down the road? Well, that's ordinary income as opposed to capital gains when you distribute. Let's say you bought a stock for $100 and you sold it for $120. That's a $20 capital gain. This tax rate is generally 15% for most taxpayers. Ordinary income, on the other hand, is your marginal tax rate. For example, married filing jointly, you've got a $100,000 taxable income. That taxed marginally at 25%. This means the next dollar earned is taxed at 25%. Any distribution from your IRA is taxed at your marginal rate. No ifs, ands, or buts about it. So now you see, you've got a trade-off here. You've deferred taxation within the IRA of all the growth and deducted contributions going in, but you've traded that away or the less favorable ordinary income taxation on the other side when you're distributing. Another caveat, if you're below 59.5, you've got a 10% penalty on any withdrawals. So say I'm 50, I want to get my hands on $10,000 quickly, so I take 10 grand out of my IRA. Well, what are the tax consequences? I'm in a 25% bracket, so there's $2,500 taxes. But because I'm under 59.5, I've got a 10% penalty. That's another $1,000 in taxes. So I'm only going to net $6,500 on that $10,000 distribution. So realize that money in IRAs and retirement accounts is long-term money. You shouldn't touch it before 59.5. Are you planning your retirement? Well, come and see us at CameronDowning. This is exactly the type of planning that we do for our clients. This has been Glenn Downing, Certified Financial Planner at CameronDowning. Please visit us at our website at www.CameronDowning.com for further information on engaging our services. You'll find my personal blog at glenjdowning.com. Take care, everybody.